Thank you for attending this Quantitative Disclosure Summary presentation. I am Kawai in JSCC's Clearing Planning Department, and I will be leading today's call. Today's meeting will be around 30 minutes, starting with an overview of this quarter, followed by the topic of this quarter, and then a briefing on the major risk points. Finally, we will try to address many of your questions as possible within the schedule. In this webinar, prior to the usual presentation of the Quantitative Disclosure Framework, we would like to give you a special presentation on the market turmoil in early August 2024, as we believe this will be of interest to many of you. All of the meeting attendees will be on mute, but if you have any questions, please let us know using the Webex Q&A function. Now, Mr. Miyauchi, JSCC's CRO, will give an overview of the quantitative disclosures from the second quarter of 2024.
Thank you. JSCC keeps 71 billion yen of skin in the game, mostly from JSCC's own capital, but it also includes contribution from affiliated exchanges. It increased by about 700 million yen compared with the previous quarter, including a 500 million yen addition to the OTC JGB silo. On aggregate, these were equal to 73% of JSCC shareholder equity. Seek to capital and seek to DF for each service are newly added in the table for your reference. During this quarter, stress test breaches where the risk amount in extreme but plausible market conditions exceeded pre-funded resources were observed on 2 days for cash securities clearing service and 1 day for ETP Energy Tocom. All of the breaches were resolved on the next business day through the requirement for additional collateral. As for margin backtesting for the past 12 months, the cover ratio was comfortably within JSCC's target, 99.5% for IRS and CDS, and 99% for other products. There were neither liquidity stress test breaches nor any participant default during this quarter. JSCC experienced no suspension of the clearing services due to system failure or for any other reasons during the past 12-month period. Now I will pass back to Ms. Kawai.
Thank you. From page 7 to page 9 is the topic on this presentation, Market Turmoil Last Month in early August 2024. As you see in the chart on page 7, the market experienced significant volatility in early August, following a combination of several market events that started with the BOJ multi-policy meeting on July 31st, when the BOJ voted to increase its short-term policy rate target to 0.25% from a range of 0% to 0.1%, and weak U.S. job figures combined with other data released during the Asian nighttime on the same day. The Nikkei reacted to these events by recording a 12.40% drop. This was a drop of 4,451.28 points, which was its largest one-day points decrease in history. Page 8 shows the impact on margin. The left-hand table shows the summary of intraday margin call and ad hoc revision for each clearing service. The margin calls were triggered during the day due to breaches of the trigger threshold for listed products and OTC JGB, but JSCC's clearing service were not affected by any settlement defaults or any other issues. Margin requirements increased mainly in listed derivatives because of higher price fluctuation rates and volatility. The right-hand chart shows the movement of margin per contract for Nikkei 225 futures. The price of Nikkei 225 futures dropped 17% across 2 days, August 1st and 5th. Accordingly, historical scenario level also increased due to a rise in the latest historical volatility. Page 9 shows the results of margin backtesting for each silo on August 9th. As expected, given the size of market moves, coverage ratios were slightly lower in some areas, but the target coverage ratios were met for all areas except for precious metals OSE and precious metal ODX. For these two markets, the parameter setting method was revised on August 26. Now back to the PQD. Page 10 is an introduction of JSCC's service structure. Clearing services are divided into 14 categories according to the governing regulations and the product features, with each maintaining its own default funds. Please note that in this presentation, some data is presented across multiple categories as the resources may be shared. Page 11 shows daily average notional value of trades cleared by asset class. We added this page in the summary from this quarter. Please note that the figures are calculated single-sided as we indicate in the explanatory notes of EQD. Page 12 shows financial resources for participant default, called Skin in the Game or SIG, and contributions from relevant exchanges and PTSs. Most of the exchange contributions from entities in the same corporate group as JSCC, namely TSE, OSE, and TOCOM. And for stress testing, the sufficiency of the financial resources for each category was tested by prorating these shared resources according to the relevant default fund amount for each category. Page 13 shows the ratio of skin in the game to JSCC's capital. The left-hand graph shows the skin in the game to be used before the mutualized default fund or DF, and the right-hand graph shows the skin in the game to be used before the default fund, both alongside default fund of non-defaulting participants on a pro rata basis. As described below, compensation by exchanges and PTSs are included in SIG for ETP. Skin in the game before default fund on the left ranges from 16 to 85% of shareholder equity. So JSCC contributes relatively large amounts of shareholder equity to skin in the game compared to other major CCPs, which shows our strong commitment to risk management. The ratios of skin in the game to default fund are newly added in this summary this quarter for your reference. The ratios on the left range from 1 to 10% of default fund, while those on the right from 2 to 14%. Page 14 shows the required default fund, which covers any default-related losses that would be mutualized among non-defaulting participants. The graph on this page shows the ratio of skin in the game and contributions from exchanges to default fund from members. The increase in default fund for ETP commodity was due to the expansion of positions by the largest participants for ETP precious metals OSE, and the decrease for IRS was due to revision of IM calculation methodology. On page 15, the data is listed for these graphs, and the amount of potential assessment, or so-called cash call, is also provided. As stated in the footnote, the cash call for any ETD is capped at 3 times the default fund requirement, and for OTC products, it is capped at 1 time the default fund requirement. Page 16 shows KCCP. Page 17 shows the largest value and mean value of the slowing, which is the stress risk amount exceeding initial margin deposited, including add-ons. Please note that due to the PFMI quantitative disclosure definitions, the default fund shown on page 14 is the value as at the end of the quarter, but the slowing on page 17 is the largest or mean value during the past 12 months period. JSCC's default assumption is covered too, except for any listed commodity derivatives other than OSE Petroleum, which is the largest one plus the 5 smallest firms in net assets. Among all clearing service categories, ETP index futures options had the largest slowing. with a peak value of 498 billion yen. Stream for ETP precious metals OSE increased from last quarter. This was due to the expansion of positions by the largest participants. Page 18 shows the number of days there was a shortfall in the stress testing of pre-funded resources and the largest shortfall. Breaches were observed on 2 days for cash securities and 1 day for ETP Energy Telecom. All were resolved on the next business day through the requirement of additional collateral. Page 19 shows the required and excess initial margin amounts. The dark blue is the house initial margin requirements and dark orange shows clients. Light blue is the excess margin for house accounts and light orange shows client accounts. The required amount of OSE listed ETP, IRS, and OTC JGB were the largest at between 1.4 to 2.6 trillion yen. Looking at the breakdown between house and clients, OSE listed ETP was driven mostly by clients. IRS was evenly split between house and clients, and OTC JGB was mostly house. This trend has remained unchanged for a quite long time. Moreover, the client's excess margin held was quite large in OSE listed ETP and IRS, which has also not changed significantly. The data used for the graph on page 19 is shown on page 20 and 21. You will see that the table of ratio of default fund to initial margin has been newly added on page 21. Now, page 22 shows the number of breaches in iron backtesting for the past 12-month period. The increase in the number of margin breaches in ETP commodity was due to market fluctuations of precious metals and rubbers, but the size of uncovered exposure was negligible. The upper chart on page 23 shows the largest breaches in the past 12 months. This test only looks at the base IM requirement without add-ons. JSCC has confirmed that these breaches would have been covered by resources such as IM add-ons, excess IM deposit, or skin in the game, and the whole amount of the default fund would have remained almost untouched. The lower chart of this page shows the largest breaches in the past 3 months. The upper chart on page 24 shows the quarterly largest value of variation margin, or VM, paid to JSCC, and the lower chart shows the largest value of IM called during each quarter. Please note that while VM needed to be deposited and settled in cash, IM may be deposited in cash as well as various securities and other instruments, giving our participants some flexibility for funding. Page 25 and 26 show the composition of collateral used for IM deposit. On page 25, you can see that the majority of ETP IM was cash, as shown in dark blue and dark orange, but some was in JGB and stocks, shown in gray and yellow. Cash collateral was held at either the central bank or at selected commercial banks. The secured cash deposit at commercial banks, in dark orange, was held in settlement accounts of commercial banks, which are fully covered by Japanese Deposit Insurance Scheme. On page 26, you can see that the majority of OTC IM was deposited in cash but with some JGBs. Deposit of stocks are not allowed for these OTC categories. The increase in the ratio of JGB's collateral for OTC JGB was due to a shift from cash to JGBs as a result of the lifting of negative interest rate. The entire amount of cash collateral for OTC JGB was held in Central Bank, and for CDS and IRS, the participants or customers may select their custodian for cash collateral, i.e. Japanese trust account or the central bank account in the name of JSCC. The secured cash deposit at commercial banks in dark orange for CDS and IRS was held in such trust account, which is legally protected from the bankruptcy of JSCC as well as the participant. Page 27 separates cash deposits into those for initial margin and default fund. We are holding a total about 8.3 trillion yen of cash collateral across all the categories. Next, page 28 shows the custodian for this cash collateral with almost 100% held in either the central bank account, settlement accounts covered by deposit insurance, or the trust account. Page 29 covers liquidity risk management. Please note JSCC liquidity risk appetite is covered too, but this data is presented based on cover 1 in accordance with PQD guidance. And while JSCC separately calculates and manages default fund by category, for liquidity risk, JSCC calculates and manages it across categories. However, for OTC JGB, JSCC has established a separate liquidity framework using repo with clearing participants because the transaction under this category involve large amount of principal settlement. In the chart, you can see that the liquidity financial resources significantly exceed the required amount and no breaches were reported in the liquidity stress testing. At the time of participant default, at least the half portion of non-cash collateral could be liquidated and applied to the settlement with survivors. However, in this data, non-cash collateral is not deducted either from JSCC's payment obligation of the estimated payment or the actual payment. Because to be conservative, we consider that it could be difficult to swiftly liquidate such collateral on the date of default. So we do not regard such collateral as available liquidity resources. Page 30 shows the liquidity resources for the categories other than OTC JGB. Cash is deposited at the central bank, shown on the first line, and secured cash deposited at commercial banks on the third line, depending on JSCC's rules. For ETP, when the clearing fund requirement exceeds 1 billion yen, half of the excess must be deposited in yen cash by each clearing participant. Therefore, the level of cash varies depending on the default fund requirement. The unsecured cash on the fourth line shows JSCC's own funds available for use as liquid financial resources following a participant default. It increased by 500 million yen due to the expansion of SIG for OTC JGB. The unsecured committed lines of credit on the sixth line shows the committed liquidity available for JSCC's parent company and multiple commercial banks that have been designated as fund settlement banks and total to more than 1.5 trillion yen. Now, we will move on to Q&A. If you have any questions, please let us know using Q&A function. Well, we received the questions from Q&A box. Are all clearing members legally committed to participate in the JGB repo commitment liquidity facility? And if so, how is each CM's commitment size?
Hello. Thank you very much.
So yes, this
liquidity
provided
in repo clearing, OTC clearing, JGB clearing services
are
are committed under the rule book of JSCC. The amount allocated to each clearing member that is basically calculated from the clearing volume of the past. So regularly we are providing the estimated amount of the liquidity requirement as reference information to each clearing member, so that they should be able to better prepare for the liquidity requirement coming in the case of a default of a clearing members. Is this addressing to your questions? Thank you very much. So the second question is that, size is based on the first cleared volume. Answer is yes. So the calculation is a little bit complicated matter. So we would be happy to send the methodology if you would be interested. It's a little bit mathematical calculations. But basically based on the activities of a clearing of each member.
Well, we received another question. Well, regarding about topics of this presentation. Did you take any specific risk management action or face any issue during the period of market turmoil in August? Well, thank you for your question. As you see in the slide 8 of this presentation, intraday margin calls were triggered due to a breach of the trigger threshold under the rules for listed products and OTC JGB. However, these actions were taken under our rule books and no special treatment. So JSCC's clearing services were not disrupted by any settlement default or other issues. We received the question from Q&A box. Question is, did you see a shift from cash to JGBs for initial margin collateral other than for OTC JGB as a result of the lifting of a negative interest rate? Our answer is at the end of Q2 2024, we see a significant move on such a shift from cash to JGBs only for OTC JGB. Depending on future interest rate trends, the ratio of cash may decrease while the proportion of securities collateral could increase in other sectors as well, so future trends maintain uncertain. Thank you for your question.
Hello, sorry. So just to getting back the previous questions regarding the liquidity required of each clearing member, that amount required of each clearing member itself is not capped. However, as I said, just for the referential information and to ensure that each clearing member can prepare for the better liquidity management, we would regularly provide the clearing member in terms of the how much the liquidity will be required from a JSCC in the scenario of the clearing member default. Thank you very much.
Well, we received a question about our slide, for this presentation. These slides you can see on our website, the page of PQD data. Sorry, we got the question from Q&A box. The collateral composition for JGB shifted from cash to non-cash. Do you see this as an issue?
Thank you very much. So yes, we have observed that shift to non-cash from cash. However, under the current market environment and based on our liquidity risk management, we don't see this is an issue that would be posing a challenge to our JSCC risk management.
Now, I would like to wrap up today's webinar. So, just for your information, as I already mentioned, you can find today's material and recording of past webinar as well as the minutes of QA sessions at the same page of PQD data on our website. So please visit our website if you're interested. Thank you for your time again. We look forward to hosting next webinar and speak to you soon. Thank you.